When a government or a massive corporation needs to raise hundreds of millions of dollars to build an airport, a railway, or solar farm, the conventional solution is simple: issue bonds. The institution borrows your cash and pays you compounding interest over time. Today, we break down Sukuk, the asset-backed alternative that completely replaces traditional debt certificates with fractional co-ownership of real-world infrastructure. The primary difference between a conventional bond and a Sukuk certificate comes down to legal substance. A conventional bondholder is a lender who owns nothing but a promise of repayment with interest. A Sukuk holder is a co-owner. When you purchase a Sukuk, your capital buys a fractional share of a tangible asset, earning you a share of the actual rent or profit that real asset generates. In the institutional space, we must draw a vital line between two structural classes: asset-based and asset-backed Sukuk. Asset-based structures rely on the creditworthiness of the issuer, using assets purely as an accounting mechanism. Asset-backed structures, however, represent the gold standard of ethical finance. They grant investors true, legal title to the physical infrastructure, offering bulletproof recourse if the enterprise defaults. Let's trace the mechanics of the most widely deployed structure, the Sukuk Al-Ijara. Imagine a national airline that wants to raise capital. Instead of borrowing money, they sell a fleet of aircraft to an independent special-purpose vehicle. The SPV issues certificates to global investors to pay for the planes. The SPV then leases those exact planes back to the airline. The airline pays regular rent, which is distributed directly to the investors as a clean, predictable yield. Because Sukuk is an open financial container, it isn't limited to leasing models. Institutions can issue Sukuk Al-Mudaraba to fund venture portfolios, Sukuk Al-Musharaka to co-found mega-industrial projects, or Sukuk Al-Murabaha to fuel massive global commodity trading pipelines, showing the absolute versatility of the framework. Conventional bonds offer a fixed coupon rate backed by nothing more than the issuing entity's ability to print money or levy taxes. Sukuk completely strips away this illusion. Your regular payouts fluctuate based on the actual performance of the underlying project. If the leased assets stop performing or generating returns, the yield naturally reflects that reality, ensuring total economic alignment. This brings us to default management. To protect the CAW rules against MICIR, equity-style Sukuk cannot guarantee that the issuer will buy back your certificates at face value if the business fails. The final payout must reflect the true market valuation of the remaining enterprise assets, cementing the non-negotiable rule that capital must share risk honestly. When we compare these instruments side by side on an institutional trading floor, the contrast is stark. A conventional bond is a passive debt extraction tool, operating entirely on credit extensions. A Sukuk is an active economic engine that anchors institutional wealth directly to the physical growth of the real economy. The Sukuk framework provides the ultimate proof that global megafinance can operate at an institutional scale without relying on predatory debt loops, driving capital back to its true purpose: building actual human progress. Now that we have completely mapped out the entire landscape of equity screening, trade finance, leasing, and institutional fixed income, we face our final structural challenge. In our next lesson, we break down TACAFL, the cooperative risk pooling model designed to entirely replace the extractive mechanisms of conventional insurance. Hit subscribe, and let's keep building wealth with a conscience.